Welcome back everyone to the Audacious Witch channel where we talk about the magic behind the stock market. The open internet as we know it is dying. Remember when surfing the net was an adventure of discovery? Every click led somewhere new. Random websites surprised us, brought us together, and gave us joy. That was the old open internet. Each corner felt alive with human creativity, but now we're trapped on the same 4 to 5 websites, walled gardens, closed internet loop. Half our conversations are with bots we can't even identify. Everything looks real, but nothing feels human with a soul anymore. Today I'm breaking down 2 companies that are at the absolute center of this. Their business models are different, but investors often have to choose between them because they are both eating from the same massive bowl of money. That bowl, it's all the ad dollars moving from old school linear TV to connected TV. The 2 companies are Roku and The Trade Desk. Here's the thing, one of them is, in my opinion, actively supporting the open internet, and the other one just took the easy way out. It took the olive branch from the enemy, chose the soulless path, and is now effectively dancing with the devil. I think this comparison is timely. The demand for digital ads is just going to grow. The more brands we have, the more competition there is. When one brand starts advertising like crazy, the next one has to, or it'll lose market share. Now, if you look at the stock charts for Roku and The Trade Desk, you'll see why I'm lumping them together. Their stocks have been moving in weirdly similar ways. Look at their moves around earnings the past year. Identical. Both dropped hard 3 times with only one positive move. We are right in the middle of earnings season again. Roku just reported and they are finally profitable for a quarter. And The Trade Desk reports on Thursday. So today I'm giving you my thoughts on Roku's results, my expectations for The Trade Desk, and I'm going to tell you which one I just sold and why. What is Roku? The good and the bad. Okay, so let's level set. What does Roku actually do? Roku is a tech company with a consumer-facing and focused. That means when consumers run out of money, Roku's business suffers in general. By hours streamed, it's the #1 TV streaming platform in the US and the UK. That is a massive position. They monetize this in 2 ways. Platform business, this is the money maker. They sell ads and get a cut of streaming subscriptions you buy through their platform. This part is ideal. It just crossed $1 billion in Q3, growing 17% year over year with a gross margin of 51.5%. Devices business, this is the hardware, the little streaming sticks, but more importantly, the Roku branded TVs and the deals to have their Roku operating system licensed on other TVs. Their model is pretty simple. More accounts and more streaming hours equals more space to sell ads. They've been adding new ad partners like Amazon's DSP. We are going to come back to that, and their own OS is a huge draw. But here's the catch. The device's revenue in Q3 was $146 million, down 5%, and the gross profit was negative $23 million, a negative 16% margin. This is the huge flashing red flag for investors. They are losing money on every TV that they sell. It's a complete loss leader. On top of that, Roku consistently dilutes its shareholders with stock-based compensation to cover their spending. Roku just reported they're profitable, but 1 quarter doesn't make a profitable company. Snap has had a few profitable quarters, and I wouldn't call it a solid company to own. So Roku's not out of the woods, not by a long shot. What is the trade desk? The Avengers of the open internet. Now let's look at the trade desk, or TTD. TTD is totally different. They don't have a consumer platform. They don't make hardware. They are a pure play enterprise software company. They are the largest independent demand side platform on the open internet. What does that mean? It means if you're an advertiser like, say, Nike, and you don't want to be locked inside Google's or Amazon's walled garden, where they control all the data and also sell their own media, you go to the trade desk. TTD is the neutral, non-biased player. They've been profitable on a GAAP basis for a year. They've scaled revenue like crazy from $1.2 billion in 2021 to a projected $2.4 billion in 2024. Their identity solution, UID2, is built to be the new privacy-first standard for the entire open internet. Their total addressable market is $1 trillion. CTV is their largest and fastest growing channel. So you can already see the difference, right? One is a hardware-heavy, consumer-facing company that is struggling for profitability, and the other is a lean, profitable business-to-business software platform. Let me know in the comments right now, just based on that, which business model do you like better? The head-to-head valuation and margins. Okay, let's talk valuation, because this is where people get stuck. TTD always trades at a premium to Roku. I'm looking at price to sales because, well, Roku isn't consistently profitable. And on the surface, you might look at the top line and say Roku's revenue is $4.5 billion and TTD's is $2.7 billion. Roku wins. But that's not the full story. TTD's compounded revenue growth has been 6 percentage points higher than Roku's. That's a huge difference and starts to justify the premium. This is the real kicker. Roku's gross margin is in the mid-40s because that hardware business is a total drag. The trade desk gross margin, it's in the high 70s. It's like a no moat or wide moat difference. This shows up everywhere. Roku has higher sales, but TTD's gross profit is still higher because the cost of goods are so much lighter. Same with cash from operations. Since 2018, TTD's cash generation has blown Roku's out of the water. Again, software versus hardware. Now I know what you're thinking, but TTD is still looking expensive. Yes, it's always been expensive. It's a high growth, high profitable company, but if you look at its price to earnings ratio, it's currently in the 60. You have to go all the way back to the 2018 or pandemic crash to find a valuation that low. And TTD is a much bigger, more profitable company right now. This is why I look at the PEG ratio, which compares price, earnings, and growth. Right now, TTD's PEG is about 8% below the sector average. That's rare. It doesn't mean it can't fall after earnings. It absolutely can, but it tells me there's an opportunity. The bear case, Amazon versus TTD. But it's not all roses for TTD. The stock is down more than 55% in 2025. Why? Slowing growth. Investors are terrified that TTD can't compete with the beast. The competition is brutal. DSPs are in a fee war. Google is cutting its costs. Amazon is playing hardball. Amazon's advertising just grew 24% to $17 billion. That's a different league. Their CEO is bragging about agentic AI tools that can create an entire ad campaign in hours, not weeks. And get this, Amazon is now going to ad agencies and offering to pay for head-to-head tests of its DSP against competitors, including covering the costs for TTD's ad inventory. They are literally paying agencies to try and prove they are better. The trade desk fired back. calling the offer biased, but the news still tanked TTD stock. It's a war. The sellout, Roku's deal with Amazon. You probably think, wow, TTD sounds screwed. But hold on, let's go back to Roku. Remember that Amazon DSP partnership I mentioned? On the surface, it sounds good. More ad partners, more revenue. But this is, in my opinion, a catastrophic long-term mistake. Roku has essentially sold its soul. Let me break down the risks. Roku's whole pitch was we're the neutral, open platform compared to Amazon Fire TV or Google TV. By giving Amazon's DSP special access, they've completely destroyed that argument. They've picked a side, and it's the side of their biggest competitor. It's like Tony Stark giving Thanos access to Stark Industry. Fueling the enemy. This deal gives Amazon's DSP a massive boost in scale and data. Roku is actively helping Amazon's ad business get stronger, which Amazon can and will weaponize right back against Roku's own OS and ad platform. Data symmetry. This is the big one. Roku is giving Amazon its valuable viewership data. What does Amazon have? All of our e-commerce and retail data. By combining these, Amazon gets a terrifyingly powerful, holistic view of us as consumers. What does Roku get in return? Just ad dollars. They are giving away their most valuable asset, their data, to their biggest rival. This deal trades a little bit of short-term revenue and a profit for a massive long-term risk of ceding control to the company that is actively trying to destroy it. Roku is still not fully profitable, and now it has chained itself to Amazon. It will always have to listen to what Amazon wants. Do you think that's worth it? Roku has 90 million users, a negative margin hardware business. It's diluting shareholders, and worst of all, it just sold its soul and its data to its biggest competitor to make the numbers look even better. It's given up its independence. What's the point of being the #1 streaming platform when you depend on Amazon to make a profit? The trade desk, it's beaten down, but that's opportunity. It's in a brutal price war with beasts. But it's a pure software business with incredible margins. It's been profitable for years, it's independent, it's non-biased, and it's building the tools like UID2 for the entire open internet. Its valuation has been reset to 2018 levels. I had to make a choice. Do I bet on the company with short-term momentum that just sacrificed its entire long-term strategy? Or do I bet on the beaten down, profitable, independent company that is actually trying to build the future of the open internet? For me, the choice was clear. I sold 100% of my Roku shares, and I used that money to buy more of the trade desk. I think Roku is a much riskier bet long term. I think the trade desk, despite the 55% drop and the Amazon fears, is the one that will be standing tall 10 years from now. Now, look, earnings are this week. Stocks have a nasty habit of dropping even on good news, so I'm not going to tell you to go all in today. If you want to build a position, maybe consider splitting your buy, some now, some after the numbers, in case it does dip. But this is why I'm making this video. I'm a long-term investor, and TTD looks like a fantastic opportunity to me, while Roku looks like a soulless trap. What do you think? Do you think Roku is now Amazon's little bitch? I find it fascinating and still feel shocked that Roku has betrayed itself. If this video is intriguing to you, please share it with your friends and family that would also find it interesting. And like and subscribe would be also amazing. That's all I ask. And I'll keep bringing you guys amazing things like this. You guys have a great rest of your day.